Hey there, traders. We're back for two daily recaps. One for Friday, March 28th. That's the down candle, the red candle here. And then today, March 31st, last day of the month and of the quarter, Q1 of 2025. So some catching up to do here. I was really nowhere around the screen. Well, I did record both Friday and Monday. Didn't take any trades. So that's kind of what I'm saying. I was busy during the trading session, during the morning session. So I wasn't trading. So I have some catching up to do to kind of analyze what's happening. And this is kind of maybe some unusual times we're in one way, not really surprising in another way, considering the big picture. We could look at a monthly chart just to remind you, maybe I'll do that right now, of where they're at, the big picture. Remember we talked about, I guess it was 610 was a target. Here's a Fibonacci extension from this big run here all the way down to this pullback, and there's 610. Several months, 3 months, 4 months or so, couldn't get above it, and they pulled back down. Not a huge surprise, and they could go lower, of course. So the weekly close last week wasn't great. They were down here. They gapped lower this morning. Monday morning, it went up, and of course, this week here, this candle could do a lot in the next 4 days. But today they gapped lower at the open, and they went up and closed above Friday's low and Friday's close. And nothing conclusive. They can still do a lot in either direction. One thing I didn't show on that monthly chart, meant to point this out, but the low of this break up candle, there was somewhat of a possible bullish consolidation if price could stay above the low of this, which was around 568 or so. And they didn't do it. They closed well below that low. Like, what is this? Maybe around 90 S&P points or so. There can be some back and forth and some lower prices. There could be a lot that could happen. Here's another thing I can point out. So the low of the month of March, where was that? It was 546.87 to be exact. And starting tomorrow, April 1st, April Fool's Day, there will be a new candle starting. We just want to point out where the low is. Here's a pretty good run all the way down from October of 2022 to the highest they made last month, February. They came down to within pennies of the 25% Fibonacci retracement before bouncing back up. Not a coincidence. Again, the precise low of the month of March was 546.87, and look where the 25% is, 546.95. They spiked it, went back up quite a bit. So would it be too surprising over the next several months for them to get down to lower targets? Just based on this little analysis here, I'm looking at where the 50% is. The 50% of this run is not going to change. It's going to be right here, 480 or so. Happens to coincide with the high they made way back in January of 2022. That would feel pretty bad probably to a lot of traders if price was all the way down here at some point this year. I'm not sure why I'm even saying this, because this is pure speculation that this might happen over the next several months, but this is the 50 period moving average going up. Price comes down. There's going to be a convergence somewhere. Just looking at this area right off the bat seems pretty compelling for being short for the next 6 months or so. But again, don't even know why I'm saying this. Let's just look at the 1 day chart. Really what they do in 1 day or less is what I'm concerned about. Anyway, they found a bottom today, bounced back up. And as we will see in the game plan that was sent out this morning, a very viable option was just to be a spectator this morning, because I really wasn't sure what was going to happen. And that's what I did, actually. Did not take any trades. Partly because I was busy, but also because I just didn't have a good feeling about the market today. But anyway, let's look at Friday first. These were the levels on Friday, March 28th, and they were sent out before the opening bell. A little bit of a game plan, some commentary about what could happen on Friday. And here's what Friday did with 3 of those levels. Every single one of these levels was a no trade because of the way price came into them. Each one was a near miss. Instead of drawing reference levels on here, I'm just going to try to explain pretty quickly here. 564.05, when they got down to it, the low was 564.11. So with a 5-cent buffer, would have been 564.10. So that's 1 penny away before they shot up about 5 or 6 points. That's what they did in the E-minis. That's a near miss. When they came back down later, you would not want to have triggered this trade, although they did bounce a little bit more. You would have been way out of the money when they did this little jolt here. This is a 10 o'clock, some type of news release, I'm sure. And then the low at this level, 562.78, they came down here, this little spike around 10 o'clock or so. The low was 562.93. So with that 5-cent buffer, once again, it's within 10 cents. So that's a little bit of a clue that they came down and hit a level, hit an area, and this level was wrong. It was off by a few pennies. But that kind of action, a near miss like that, is enough for me to say, well, if they come back down into that level again, I'm not going to want to get on the long side the way they're acting. Sure enough, they sliced right through it. And then the same thing happened here, 561.12. We'll go ahead and adjust this because maybe zoom in a little bit, make it bigger. So 561.12 will be 561.17 with your 5-cent buffer. So they got to a low of 561.20 there, 5 pennies away. And in the next minute, they are up just about enough for a base hit. They did that several times. Ended up hitting the level, but coming up short of a 4-point base hit. If they can't give you 40 cents in the SPY or 4 points in the E-minis after a couple tries like that, they're probably not going to bounce much higher. They're going to probably go down, which is exactly what they did here. So no trades strictly playing by the rules, but if you had seen this kind of thing, again, I wasn't paying much attention to the market. I didn't make any trades on Friday, but I'm not sure what I would have done. But had you been looking at this and paying attention, these levels, the way they were working, it could have been kind of a clue maybe at this point that the bears were in control and prices was going to go lower, and maybe you could have jumped on board and ridden this thing down. I'm not saying you should have or would have. I'm just saying that price was acting a little out of character and giving you a few clues along the way. Over to this morning. This is Monday, the 31st, and here are the levels. A little bit of a zone at the top. You can read through all this. Notice the time. These levels were sent out before the opening bell per usual. And here's what the entire day looked like. The blue lines, of course, are our levels. I just put some reference levels down here. I'm going to talk about this in a minute. So 3 levels were hit, and if you're playing by the rules, the first trade would have been a short trade as they came back up into 549.60 because you'd given the market 15 minutes to settle in. So 9:45, they're down here somewhere. The level for the morning was 549.65. I already had this pulled down with that 5-cent buffer. Immediately out of the money, quite a bit, just shy of 20 points here. Possibly would have hit 20 points in the E-minis, but there was not a fumble signal given this entire time, and now they're back down at your entry point. And I just want to point out that if this has been a successful short trade and they got above the level, at some point after 20 minutes or longer is usually good, you'd be looking for a long trade if they came back down and bounced off this level. They did. It was 20 minutes. So if you're thinking about this and you're seeing them come back down and they bounced enough from that level to give a base hit on the long side, and they did all this back and forth for 10 or 11 or 12 minutes or so, that not sure I would have wanted to stay on the short side after all this, after withstanding all this and then getting back to your break even. You would have had the opportunity to jump out. You really would have had the opportunity to buy and then make a profit on the long side, but they got above this thing. They would have hit that max loss limit when they got above here, 20 points. So I'm just going to be fair and say, if you were in this trade, because I don't know what I would have done. I was not in the trade. I'll show you the recording of it if you want to see it. So I didn't take the trade, but I'm just saying this type of action here, knowing that a recycled trade will bounce here, it's perfectly viable after this type of behavior. And the question is, do you want to be still short after all this? But anyway, we're going to say it was a max loss limit, just to be fair. It's unfortunate, but we're going to call it like it is. Then they meandered around and continued higher. And once again, this next level, 555.67, was not respected, at least when they sliced right through it. They came down and bounced off of it a few minutes later, but there was around a 12 or 12.5 point fumble. Then the reversal would have given you at least a 4-point wash, a base hit on their way back up as they continued higher. And then when they got to 559.37, the time, it was 3:42 p.m. While this level was the only one that would have worked correctly, it was too late in the day to trade by my rules, so we're not going to count that. So not a really good day, not a good way to start the week, and it's kind of unusual. And it's one of those days, might have been better to not trade. And just to reiterate that, I'm just going to point out this last sentence in the game plan this morning. That the way things are going, it might be good to interpret all this as the market might have other ideas, as being an observer is certainly a position to take. That means to not trade, sit on the sidelines. And for what it's worth, that's what I did both days, mainly because Friday I had some meetings in the morning, so I just let this thing run while I was in the meetings. So I had some time before, I think it was 11 or so, thought I could get into a trade. That's when that near miss happened. They came up close, so I didn't trade it. I'll just back up so you can see this again. Well, there's a lot of flashing around here. Made the level dotted, and that's my indication that the level is not going to be traded because of that near miss. I wasn't even to look at the market when this happened. I saw this. I'm like, all right, I'm not going to jump in front of that. After that signal, so I didn't trade it. And then 11 o'clock, I was away from my screen pretty much for the next hour and a half or so. So this just went on until after noon. So no trades on Friday. And here's today. Notice the time. I actually was in a meeting from 9 a.m. till, I forget what time it was, but we'll see in a minute when I started messing around with this. But I just let this thing run. I just have this I have the video sped up to right before the market opens. So the market opens, I'm not in front of my computer until there, almost 10 o'clock. So this is when I'm thinking they're going to come down here. I'll go long at 5:45. Wasn't even paying attention. They even went off the screen. Wasn't paying attention to 549.65. And honestly, that was to my credit, or that was kind of luck more like it, because I probably would have gone short here. I didn't, just because I was away from my computer, not paying attention to the market at the time, just couldn't. And so all this I missed. Let me scrub ahead here and show you when I got back. Here, I just moved the screen down. Saw what happened, and so everything is dotted. I'm not going to mess with anything until. So I let this thing run. I want to see what they were going to do to 555.67. Made my mind up I wasn't going to trade it, but they came up short at some point. They pulled back down. Started to pull back down. I was like, all right, I'm not going to mess around with, no sense in recording and having this extra data saved on my computer when I don't need to. So I stopped around 120 or so. No trades on Monday. And that makes the tracking logs look like this for Friday and Monday. You can read the notes for both days. If you were playing by the rules, you would have had nothing gained, nothing lost on Friday. And today you would have given a few points, maybe quite a bit, depends on your trading ability, quite a bit of points and dollars back to the market. And we dropped our rate of return down because of that. And my trades look like this. I'm just kind of hanging tight to where I'm at. I want to point something out also in terms of playing by the rules. While the TKO and fumble ratio is kind of high compared to the overall average, which is more like 3.5% or so, maybe less than that, in terms of how many TKOs over the long run that I've been tracking this, the average is pretty good. Like the rate of return and the daily average trading these two contract trades per level is still pretty good. I think it's like the long-term average of trading two contracts at every single level, every single day, since January of 2022 through now is more like $400 and maybe $11 a day. Even with these metrics so far this year, we're above the average here. So it'll balance out over time. Just want to point that out. So that's it for Friday and for Monday. Tomorrow is the first day of April and a new month. The bulls have some work cut out if they want to go higher. They can certainly do it if they try, but we looked at the big picture. On the monthly chart, they're making things look pretty weak in the big picture. Are they going down farther? Is this just a big kind of taking a break and going sideways for a while before they go higher again? Or are we in the middle of something? And I will also, it might be good to point out, maybe getting way ahead of myself here, but when you have typically in the market, when you have some type of big fall, like I'll just even call it a recession, it doesn't happen from like all-time highs. It happens when they start breaking down and they get below certain areas. And once they get weak below certain areas on larger time frames, like the monthly chart, which they still have a ways to go, they're still above all the moving averages on the monthly chart. But once they get below certain areas, that's when the recession starts. So that's when you can officially say the market, at least the SPY, is in a bear market, in a recession. But I'm no economist. I'm not a long-term kind of guy. Just pointing out what's obvious to me on the at face value. What I'm more concerned about are finding levels that work with these little trades that we take in the E-minis that work most of the time. So we'll see what happens for the rest of this week, and hopefully we'll catch up some of the ground that we lost today. We should know by the end of the week. So that's a wrap for today. Thank you for watching. I hope you learned something. I hope you didn't lose too much money today if you traded the levels. It does happen sometimes, but it's all part of trading. I'll talk to you again soon in the next recap. Have a great day.